In early 2026, something pretty wild happened in the silver market. It was one of those moments that delivered a lifetime of gains and losses, all in the span of just a few weeks. It left a lot of stunned investors in its wake. So, we're going to break down this incredible story of a massive boom and an even bigger bust. So you had this global frenzy, right? Silver, which has kind of always been in gold's shadow, finally had its big moment. It blasted past this huge psychological barrier, briefly hitting over $100 an ounce. I mean, that's a number that analysts had only ever dreamed of. The excitement was just electric. And then, just like that, the bottom fell out. In one single, absolutely brutal day of trading, the price crashed by 30%. Now, to put that in perspective, that was the worst single-day drop since 1980, back during the whole infamous Hunt Brothers saga. Just devastating. Which, of course, brings us to the big question we're tackling here. How on earth did this happen? How did a rally that started with solid reasons spiral so out of control and pop so violently? And maybe more importantly, were there any warning signs? Well, it turns out the answer was hiding in plain sight. You see, the key to understanding this whole mess lies in a simple but really powerful tool. It's something professional investors have used for decades to navigate these choppy waters in precious metals. It's called the gold to silver ratio. So, what is this thing, the GSR? It's actually incredibly simple. You just take the price of 1 ounce of gold and divide it by the price of 1 ounce of silver. That's it. The number you get tells you exactly how many ounces of silver it takes to buy 1 single ounce of gold. It's just a clean way to measure their value against each other. And here's why it's so useful as a signal. When that ratio is high, let's say over 80, it's basically shouting that silver is historically cheap compared to gold. It takes a whole lot of silver to buy that gold. But when the ratio gets really low, like below 40, it's a warning. It's telling you that silver might be getting way too expensive relative to gold. There's a reason investors need a tool like this, especially for silver. It's earned this notorious nickname, the devil's metal. Not because it's evil, but because, man, is it volatile. Silver can make you an absolute fortune, but it can also inflict these sudden, really severe losses, especially on people who get swept up in the emotion of it all. And look, this isn't just some abstract theory. Let's dive in and see how this ratio has acted like a foghorn throughout history, flagging these huge turning points time and time again. Just check out this timeline of the extremes. In 1980, the ratio crashed down to 17, screaming that silver was overvalued, right before it collapsed. Then you fast forward to 1991, it hits 100, which signaled that silver was a total bargain. In 2011, it fell to 32, just as silver was about to peak near $50 an ounce. And get this, during the panic in 2020, it spiked to a record 125, which marked literally the best time to buy silver in modern history. So what you get is this crucial, simple rule of thumb that has worked out pretty well for investors. A ratio above 80 has generally been a green light, a sign that silver is a pretty good value. A ratio below 40, that's been a flashing red warning light that things are getting way too speculative. Okay, so let's apply all of this back to that 2026 rally. What was actually driving the price? Because it's really important to separate the solid, fundamental reasons from the speculative frenzy that took over. Now, to be fair, there was a very real, very solid case for silver. I mean, you had this insane industrial demand coming from AI data centers, from solar panels, from EVs. It created a real supply shortage. On top of that, central banks were buying gold by the truckload, and that created this positive spillover as investors looked for other ways to hedge their bets. This was the solid foundation. But then came the FOMO, the fear of missing out. As the price climbed, the media hype went into overdrive, which fueled this huge wave of everyday people jumping in. At that point, people weren't buying based on value anymore. They were just chasing performance, desperate not to miss the rocket ship. And that's when this thing went from an investment to a mania.
Welcome back and check out the price action in precious metals. We've been getting questions about this all morning long. Gold, silver, copper, all touching record highs today, but also seeing some big volatility this morning. Gold and silver are on pace for their best month in more than 45 years, by the way.
Gold and silver jumping to all-time highs as escalating geopolitical tensions boost the historic rally. Bloomberg's Tatiana Daria joins us now. Tatiana, let's end with the question, We heard from Cameron Dawson earlier this week. I think the question is, how much can it continue? Can this rally continue?
Well, we have to ask ourselves if the macro conditions and sort of the catalysts that are playing into this rally will continue, and consensus think that they will.
You know, every bubble needs a pin. So what was it this time? What was that specific trigger that finally brought this whole thing to a sudden, screeching halt? Believe it or not, it was this news headline.
Welcome back. Well, breaking news right now. President Trump just posted his new chairman of the Federal Reserve will be Kevin Warsh. The president just posted it on Truth Social. As we expected, it is the former Federal Reserve Governor, Kevin Warsh, as the next chairman of the Fed.
So why did this one name matter so much? Well, Warsh is known in financial circles as a hawk. That's just someone who favors tighter money to fight inflation. His nomination instantly killed any expectation of easy money or future rate cuts. That caused the US dollar to spike, and a stronger dollar is basically poison for precious metals prices. The entire story that fueled the rally was shattered, and everyone rushed for the exit at the exact same time.
Today, at one point, the Dow was down 611 points. You can see the big comeback. The S&P had been down 75 points. Everybody's still in the red at the moment, but these intradays, what does that say to you about the market sentiment, whether it is the Kevin Warsh Fed nominee number or something else?
Yeah, I think today was all about Kevin Warsh. I mean, Kevin's a really interesting figure, right? 2008, he's out there saying, don't cut rates as the market's melting down, housing market's deflating, right? And yet we have a president who's out there pounding the drum that rates need to go lower, and he's the next Fed chair pick. Okay, so I think the market's very confused. Look at gold. Gold's down 10% today. Silver was down 30% at one point. Right? These are all signals that inflation is going to be tamed. That's what you'd expect if you got a hawkish Fed. Meanwhile, the market's down. Right? The market's down because the market actually thinks that Warsh is probably going to keep rates a little bit higher, which is going to make the investment, especially in AI, a little bit more expensive because the market has now turned. These large tech companies have turned to the bond market to fund their capex. And so I think that's what's happening today. There was a recalibration about what the future rate of interest, what the future path of interest rates is, as the market was adjusting the fact that Warsh, while he speaks as a dove, is probably a little bit more hawkish when it comes to inflation.
Yeah.
So what's the big takeaway from all this, from this whole incredible story? Let's try and pull it all together into a clear, actionable idea for anyone who's trying to invest in these volatile markets. A disciplined investor's edge really comes from a pretty simple process. Number one, analyze the real fundamentals, what's actually going on. 2, always keep an eye on the ratio. It's your value signal. 3, and this is the hardest one, learn to ignore the media hype and the FOMO. And 4, use that info to choose your price and don't get sucked into chasing somebody else's. And this really gets right to the heart of the lesson. You can be 100% right about the long-term story for something like silver, but if you buy it during a crazy speculative bubble, you can still lose a fortune. Patience and being disciplined about the price you're willing to pay, that's often way more important than just being convinced you're right.